The last videos Hey guys, in the last videos we discussed about the investment banking questions, and this is the video 4 of that part. So in this video we are going to discuss about the valuation series of the particular company. So when you use a liquidation value, and how you get the most of the benefit of that. So this is the most common in the bankruptcy scenario. Like it's used to see whether equity shareholder will receive any capital after the company's debt have been paid off. So this is one thing. It is often used to advise a struggling business on whether it's better to sell off the assets or separately or try to sell the entire company. So when you use the sum of parts method, so how will we define? So it's the most often used when a company has a completely different or unrelated division, and a conglomerate like General Electric like go for that. So sum of part, or we can say that the Reliance want to value its business. So in that case, Reliance will value the geo business as separate, and the petrochemicals business separate, because they are the different multiples, and apart from that they are the different precedent transaction, comparable transaction analysis as well. So that will be the another number for them. Instead of that, you should use the different set of the each division, or value the each one separately, add them together to get the combined value. So this will be another scene. When do you use an LBO analysis for the part of valuation? Obviously you use this when you are looking for a leverage buyout, but this is also used to establish like how much a private equity firm could pay, which is usually lower than the what a company will pay. So it's a it's a floor value, something like that. And what are the most common multiple for them? So first one is technology multiple. So it's a EV by unique visitor, so EV by page reviews. Like let's say you are a tech website or a blog, how many visitors will visit on your platform, so that's another number, and the page views as well. Then we have the retain airlines, etc., EV by EBITDA. So it's earning before interest, tax and depreciation, and amortization, rental expenses. So that's a EBITDA for the fixed expenses for the airline and retail spaces as well, because they require the rent expenses as a high cost. Then we have the energy, it's a EV by EBITDA. So it's earning before interest, tax, depreciation, amortization, and explanation expenses. So that one is that. And then we have the EV by daily production and EV by crude reserve quantity. So this one is the another calculation scenario for the number of the market hypothesis. Then we have the real estate investment trust. So it's a REIT. So it's a price by FFO per share, and it's a price by AFO per share. So it's a fund from operations and the adjusted fund from the operations. So that is depend on the real estate investment trust. Then we have the technology and energy. That should be straightforward, and you are looking at the traffic and energy reserve as a value drivers for them rather than the revenue or profit. Then we have the retail airlines. You should add back the rent, because some companies own their own buildings and rentals and capitalize the expenses when the other rents are also there. So that's a one thing then, and consider as a rental expense. Then we have the energy. Like for the energy, all value is derived from the company's reserves of oil and gas, like which explain the last of two multiples. EBITDAX is the some companies capitalize their exploration expenses and some expense them for the another scenario, and you add back the exploration expenses to normalize the number. So this is one thing. Like for the REIT or something like that, like fund from the operation is a common metric that added back the depreciation and subtract the gains on the sales of property tax. So this is one thing. And the depreciation is a non-cash, or we can say that the extremely large expenses in the real estate that gain on the sale of property are assumed to be non-recurring expense. And FFO is used as a normalized picture of the cash flow and REIT is generating right now. So this is the one thing. So when you're looking at the industry specific multiples like EU by scientists or EU by subscribers, why do you use the enterprise value rather than the equity value? So say that the enterprise value is because the scientists and subscribers are available to all of the investors, both debt and equities in a company. So same logic doesn't apply to everything. You need to think through the multiples and to see like the which investor is particular metrics and which is available to. So this is one thing. Like how to present the valuation methodology to a company or its investors. In these cases, like you use the football field charts. So when you show the valuation range implemented by the each methodology, you can also show a range rather than the one specific number. And this is going to be the another method for them on the basis of different parameters. That will be another scenario. So and the another one, how do you value an apple tree? The same way, like you could value a company by looking the comparable apple trees, the worth, like the relative valuation, and the value of the apple trees cash flow in the future. That will be intrinsic value. So that could be d for anything, even for the apple tree as well. So that's a pretty better analysis for this. Let's meet in the next video. Subscribe our channel for the more content.